In this video, we're going to talk about a specific type of Type A tax-free reorganization, and that is the forward triangular merger. So let's say that you're the director of a corporation called Amazing Animals, and let's say that you have a retirement home for animals, and you decide that you want to acquire another firm called Turtles and Things, which is a retirement home just for turtles. And so you want to acquire this company, so you are the purchasing corporation, you're the purchaser, and Turtles and Things is going to be the target. Now, if we were just to do a regular Type A merger, you could just have where Turtles and Things just merges directly into Amazing Animals. But one of the things is that you're going to get all the liabilities of Turtles and Things. And maybe they have some environmental liabilities or something like that, some contingent liabilities that you're not aware of. You don't want any part of that. And so now there's this new option, this forward triangular merger. And what you can do is you can either create a subsidiary. So let's say we've got down here this subsidiary, we'll call it Animal Heaven. So Animal Heaven, this could either be an existing subsidiary of Amazing Animals, or you could create it specifically for this purpose, for this merger. And what you're going to do now, Animal Heaven is the subsidiary, so we're going to call this the sub. This is a subsidiary of Amazing Animals. And what's going to happen is that Turtles and Things is actually going to merge into Animal Heaven, not into Amazing Animals. So Amazing Animals is still the purchaser, and Turtles and Things is still the target. It's just that you have this third group now, this subsidiary, and instead of Turtles and Things merging into Amazing Animals, it's merging into Amazing Animals subsidiary, which is Animal Heaven. And so this is why they call it a triangular merger, because here you see that we have kind of a triangle shape. Now, there are some requirements for a forward triangular merger. First of which is that basically this merger must have qualified as a regular Type A merger, had the target, which in this case is Turtles and Things, had Turtles and Things merged directly into Amazing Animals. So if it didn't meet the requirements to merge into Amazing Animals directly, then it's not going to qualify as a forward triangular merger. Now, there are also some specific requirements related to forward triangular mergers that didn't apply to a regular Type A merger, and that is that basically, so the purchaser, in this case, which is Amazing Animals, remember Amazing Animals, even though it's got this sub that Turtles and Things is merging into, Amazing Animals is still the purchaser here. Okay, so the purchaser, Amazing Animals, must acquire substantially all of the target's assets. Okay, and that's it. It's going to be, what do you mean by substantially all? Well, 70% of the gross assets of Turtles and Things and 90% of the net assets. So we have that requirement. That's actually similar to a Type C if you watch the video that I have on that. And now an additional requirement though is that the subsidiary stock, so now we're talking, and I know it's a little confusing, hang in there, the subsidiary Animal Heaven, their stock cannot be used as consideration, right? So when the purchaser, when Amazing Animals is buying Turtles and Things, even though Turtles and Things is merging into Animal Heaven, if Animal Heaven has any stock of its own, that stock cannot be used to be given to the target in this to make the deal go down, right? It has to be purchaser stock, Amazing Animal stock that is being given to Turtles and Things, okay? So that now there's a little bit of flexibility here in terms of, although stock of Animal Heaven, of this subsidiary, cannot be given to Turtles and Things, you could have debt, for example, or something like that. So there are other things that Animal Heaven could feasibly contribute. Now remember, the main advantage of doing this forward triangular merger is that the purchaser is not going to receive the target's liabilities. And the reason is that the subsidiary is going to be getting the liabilities. So Turtles and Things is merging into Animal Heaven, into the subsidiary, not into Amazing Animals. So any kind of contingent liabilities or something are going to be taken by Animal Heaven, not by Amazing Animals. And that's why this is a popular type of reorganization with many corporations.